Hey, welcome back to another quick episode of the Main Street Money Show podcast. And I'm pretty excited about these next couple steps in the Wealth Steps order of operations. And you're probably thinking, oh, well, you don't sound excited. I'm a pretty neutral guy. I'm kind of level-headed, pretty unemotional in the sense of, the highs of highs and the lows of lows. I'm pretty even keeled. So I listen to a lot of these podcasts that I record and just sort of, practicing my communication and practicing my speaking and public speaking and speaking in front of a microphone, that kind of stuff. And I got to say, working on a podcast and listening to yourself talk will definitely bring about some improvements in how you try to articulate ideas, how to make them more relatable. And I've noticed that over the course of these episodes that I feel like they're getting a little bit more interesting, a little bit entertaining rather than just completely, mundane information. And even though I try to keep them short to the point, if you've got feedback for me on how to improve these podcasts, I'm all ears. So you can go on my Facebook page. It's 72 Advisors. Follow me and give me some feedback there. Like my posts, share, that kind of stuff. I've got plenty of resources out here for you. I've got these educational videos that I'm trying to do more on YouTube, and I'm trying to do more of in-person speaking and doing these workshops where we're actually teaching these concepts and we're teaching about how to implement them in your own life without having to spend $4, $5, $6, $7,000 for financial planning fees to get it done. And I'm not saying it's not worth it, because I do charge those fees and people pay them, but sometimes it's best to be exposed to the material before you go out and just spend the money to get it done. Now, part of the value add of a financial advisor is they're saving you time, so you don't have to go out and learn these concepts. They're just going to teach them to you and implement them for you. But it's putting the time back in your time pocketbook so you can spend it with your family, your friends, and do the things that you want to do without having to worry about, are your finances taken care of. But for the individuals that want to DIY it, there's plenty of good channels on YouTube. I watch a lot of them. I hope you would consider my channel on YouTube a good one as well. And if you haven't subscribed, I'd appreciate that. But when we work through this step 4, the Wealth Steps order of operations, this first playlist, if you're watching it on YouTube, I've got a playlist that's titled Wealth Steps Order of Operations. And ultimately what I'm trying to do is show everyone the framework and the strategy and the process that you need to go through as an individual if you're going to DIY it yourself to organize and make improvements to your financial life. And there's a lot of different subtopics, and I've mentioned that over and over again, is that this isn't specific to your situation. However, it may be a subject matter that you need to go out and do a couple more, hours of research on. So in this little subtopic of step 4 of the working years and the Wealth Steps order of operations, we're talking about risk profile. And so I mentioned it in the last episode, and that was, every individual that I've worked with, chatted with about their finances, it's very obvious that some people do not want to take a lot of risks. And the question is, well, when do I need to take the risk, and why should I take the risk? The whole goal of investing in real estate or business or the stock market is to beat inflation, and it's one, to put money in your pocket, but two, it's also to beat inflation. So this is year 2025. In the last 5 years, inflation has been pretty steep. I'm guesstimating probably in between 15 to 25%. Now, that's not what you would see on the news. The news would say it's less than 10%, and that's completely not true based off just resources that I've found. However, when we talk about risk profile, before you invest any money with yourself at any custodian, or whether it's with the individual. So if someone came to me and said, hey, I want you to invest this money for me, we're going to start talking about what is your risk profile. So do you expect this money to return to you, 2x, 3x, 4x? Because we have to set expectations of what's a good number to target over the next 10 years, 20 years, 30 years, or is this money for the next 2 to 3 years? Because depending on what time frame the money is allocated towards, we have to figure out, can we be a little bit more aggressive to pursue a little bit higher rate of return? Or do we need to be a little bit more conservative and not put it in the market at all, and not put it in your business at all, and not put it in real estate, but just put it into a high yield savings account where you're getting 3, 4, 5%, or maybe into some type of CD where you might catch 5.5%, or some type of multi-year guaranteed annuity, and depending on what interest rates are. And a multi-year guarantee annuity is just the insurance version equivalent of a bank CD. So what you can do, you can research all these different conservative, I'm hesitant to call them investments. I'll call them allocations. So if you say, hey, out of this $200,000 or $500,000 or $1 million, I want 20% to be in something very conservative, 3, 4, 5%. I want something that's going to be a little bit more aggressive. So I might put, 50% into something that we can expect to get 7, 8, 9, 10 plus rate of return based on what the market's doing. And that's where going back and looking at what the stock market does historically is going to play out in your favor. So you have an idea of what you can expect. But, asterisk right here beside this, if you've looked at any type of investor sheet, on the bottom of it, it's going to say results are not, past performance is not indicative of future results. And basically what it says is, I don't care what the past has done, the history, we don't know it, and it could drop 500% in the whole market crash. Who knows? We don't know what the future is going to do, but what we do know historically, based on different asset classes, real estate, stocks, cash equivalents, CDs, businesses, we can have an idea of what kind of rate of return that we can get based off of what asset class we go after. So that's where you, as a consumer, you got to figure out what your risk profile is. So if you're working with a financial advisor, most likely, and they talk about the investing portion of it, they're going to come to the table and say, hey, we're going to need you to fill out this risk profile questionnaire. Maybe it's on paper, maybe it is some type of digital questionnaire, but ultimately we have to figure out what is your risk tolerance. So whether or not you're doing it on your own or looking through some type of online platform that you're looking through the different asset classes and stocks and that kind of stuff, I highly recommend doing your own due diligence and figuring out what your risk profile is for your situation. So that's it for this video.